Something is broken, and almost nobody on the financial channels will say it out loud. For as long as most of us have been investing, there was a rule you could set your watch by. When interest rates on safe bonds went up, gold went down. Every advisor knew it. Every trading desk built on it. It was supposed to be as reliable as gravity. And lately, that rule has simply stopped working. If you own gold right now, or you have been thinking about it, this matters to you directly. Because the number that brought you here, the one in the title, is not a fluke, and it is not a bubble waiting to pop the moment rates tick higher. It is a signal that the machine underneath your retirement has changed. And here is my promise to you. By the end of this, you will understand what actually broke, why the people who moved the most money already knew, and what it means for the savings you spent a lifetime building. Let me give you the one fact that cracks this whole thing open, and I will give it to you right now instead of making you wait. For decades, gold and the return on safe government bonds moved like two ends of a seesaw. When a bond started paying you a real return after inflation, gold fell because gold pays you no interest at all. Why hold a rock that pays nothing when a treasury bond pays you to wait? That was the logic. It held for a generation. And in the last stretch, that seesaw broke. Bond yields stayed high. The real return after inflation stayed positive, and gold climbed anyway, to record after record, doing the exact opposite of what the textbook swore it would do. Now, why should you care that some correlation on a chart stopped behaving? Because that correlation was the foundation of every reason your advisor ever gave you to keep gold small, or to keep it out of your retirement account entirely. The whole case against gold rested on one sentence. When rates rise, gold falls. So in a world of higher rates, you do not need it. That sentence is now wrong. And the fact that it is wrong is the most important thing happening in money today, precisely because the people who told you that sentence have every reason not to admit it. Let me take you back, because you cannot understand how strange this is without seeing how ironclad the old rule used to be. Think about the early 1980s. A determined Federal Reserve chairman took interest rates up into the high teens, punishing brutal levels. Real returns on safe bonds went sharply positive, and gold, which had run for most of that decade, was broken. Not for a month, for roughly 2 decades. A bond that pays you a genuine return after inflation has always been the one true enemy of gold, because it beats gold at gold's own game, safety plus a paycheck. For 20 years, that enemy won. So every professional who came up in that world learned the same reflex. Rates up, gold down. They watched it happen. They traded it for their entire careers. And when the taper scare hit, back when the Fed merely hinted it might slow its bond buying, gold fell hard in a single year, a punishing drop, on nothing more than a hint of tighter money. The rule was alive and well. Yields threaten to rise, gold gets crushed. That is the world your advisor still lives in. That is the world that no longer exists. Here is where the investigation gets interesting, because the rule did not just fade quietly. It reversed while everyone was looking the other way. In the most recent stretch, we have had exactly the conditions that were supposed to bury gold. Safe bonds paying a real return again. A Federal Reserve that has held rates firm, refusing to cut on demand. Under a chairman, Kevin Warsh, who has openly called inflation a choice and stripped away the soothing forward guidance the market used to lean on. This is a hawkish, unapologetic Fed. By every rule your advisor memorized, gold should be sliding. Instead, it went to records. Something is buying gold that does not care about the interest rate seesaw at all, and that something is the whole story. Who buys gold and does not care that a bond pays a real yield? Not a hedge fund chasing the trade, not the retail crowd. The buyer that broke the rule is the central banks of the world, the very institutions that print the currencies. For 3 straight years, the world's central banks bought more than 1,000 tons of gold a year, roughly double the pace of the decade before. They were not doing it to earn interest. A central bank does not buy gold for yield. It buys gold because gold is the one reserve asset that is no one else's promise, no one else's debt, that cannot be printed, defaulted on, or frozen. And when the biggest, most price-insensitive buyer on earth is accumulating regardless of what bonds pay, the old seesaw simply does not apply anymore. Let me sit on that word, frozen, because it is the hinge of this entire shift. A few years ago, the world watched one major power have a large share of its foreign reserves frozen, locked up, made unusable overnight in a financial dispute between nations. Every central bank on earth took the same lesson at the same time. The government bonds you hold in someone else's system can be switched off. Gold sitting in your own vault cannot. It cannot be frozen by another country's decision. It has no counterparty who can say no. And in that moment, gold stopped being a bet on interest rates and became something older and simpler: insurance against the system itself. Insurance does not go on sale just because bonds got more attractive. That is why the rule broke. Now, I need to pause here because this is exactly the point where you should stop and think about your own money, not just the central bank's money. Here is the truth almost nobody spells out for a retiree. The largest, best informed buyers on the planet are quietly moving into physical gold at a record pace, and there is a perfectly legal way for an ordinary American to do the very same thing inside the retirement account they already have. You can move a portion of an existing 401k or an IRA into physical gold and silver, real metal, without cashing out, without triggering taxes, without early withdrawal penalties. It is called a self-directed precious metals IRA, and it is not some exotic loophole for insiders. If you have $100,000 or more in any retirement account, this is squarely for you. I put together a free retirement protection guide that walks through exactly how it works in plain English. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. It is free, there is no obligation, and for 100,000 plus accounts, there is a no-cost one-on-one to answer your specific questions. Then come right back, because the next piece is the part the banks would rather you never connect. Because here is what the broken rule is really telling you. For most of our lifetimes, the case for owning your currency and your bonds rested on trust, the quiet assumption that the dollar and the debt behind it were as good as gold, better even, because they paid you to hold them. Gold's price obeying the interest rate seesaw was a symptom of that trust. When trust is high, you only hold gold if the math forces you to. When the biggest institutions on earth start buying gold in spite of the math, they are telling you, with their own reserves, that the trust is thinning. That is what a broken correlation looks like from the inside. It is not a chart quirk. It is a vote of no confidence, cast in metal. And you do not have to guess whether this is real, because it has already crossed a line that would have been unthinkable a generation ago. Gold has now passed the euro to become the second largest reserve asset held by central banks in the entire world, sitting behind only the United States dollar. Think about what that means. The collective judgment of the institutions that manage the savings of nations now rates a metal that pays no interest above one of the world's major currencies. They are not doing that for yield. They are doing it for safety, for permanence, for the one asset that answers to nobody. That is the seesaw, snapped in half in the open, and the financial press barely mentions it. Let me name the enemy plainly, because you deserve to understand why you are only hearing this now. The big banks, the brokerage houses, the financial media that runs on their advertising. They built an entire business on the old rule. Their models, their fee-based portfolios, their comfortable story that stocks and bonds are all a sensible person needs, all of it assumes gold is a relic that misbehaves when rates rise. A world where gold climbs through high rates is a world where their story is broken and their clients start asking why they own none of it. They are not lying to you out of malice. They are simply the last people on earth with an incentive to tell you the rulebook changed. Their comfort depends on your not noticing. And I want you to notice something about the word rule itself, because it is the key to the whole investigation. A rule in markets is not a law of nature. It is a habit that holds until the conditions underneath it change. The rules of money have always been man-made, and they have always been changed, sometimes overnight, by the people with the authority to change them. Go back to the depths of the 1930s. In a single stroke, by government decree, the dollar price of gold was revalued upward by roughly 2/3. The official price lifted almost 70%, just like that, because the authorities decided the old number no longer served them. The rule that had held the price fixed was simply rewritten. If you had built your entire understanding of money on that fixed price, you woke up one morning in a different world. That is what a broken rule feels like from the inside, and it is exactly what longtime gold skeptics are living through right now, only in slow motion. Here is another layer the financial channels will not walk you through, because it points straight at their comfortable story. Why would the biggest institutions on Earth decide all at once that the old interest rate logic no longer protects them? Look at the debt. The government bonds that were supposed to be the ultimate safe asset now sit on top of a national debt so large it grows faster than the economy that is meant to service it. When the pile of debt gets big enough, a quiet pressure builds on the central bank to keep the government solvent rather than to fight inflation with everything it has. Economists have a dry name for that pressure, but you do not need the jargon. You need the consequence. It means the promise inside a government bond that it will pay you back in money that still holds its value becomes a little less certain every year. And when that promise softens, a bond paying a real yield stops being the airtight enemy of gold it used to be. The enemy got weaker. Gold noticed before the crowd did. There is a reason I keep saying physical, real metal, and not just gold. Because the same institutions breaking the old rule are voting with a specific kind of gold. Gold they can hold. Gold in their own vaults. Not a paper claim that says gold somewhere in someone else's ledger. In the paper markets, there can be many claims stacked on top of every real ounce, and everyone assumes they will never all show up at the vault door at the same time. Usually they do not. But the whole lesson of the reserve freeze, the whole reason central banks are pulling metal home, is that usually is not the same as always. A paper promise is only as good as the system that stands behind it, and the entire point of this shift is that the biggest players have started to doubt the system. When you own physical metal, you are not trusting anyone's promise. That distinction sounds academic until the day it is the only thing that matters, and by then, it is too late to fix. Now, here is the part that actually changes things, the piece almost nobody connects. If gold no longer waits for interest rates to fall before it rises, then the single biggest break on its price for the last 40 years has been released. For 4 decades, every gold rally lived under the same threat. Rates might rise and the rally would die. That fear capped every move. But if the largest buyers have decided that gold is worth owning regardless of what bonds pay, then that ceiling is gone. The thing that used to reliably stop gold no longer stops it. And a market that has lost its break does not behave the way a market with a break behaves. That is the quiet, enormous shift underneath the number in the title. I want to be honest with you, because that is the whole point of this channel, and there are plenty of people who will tell you only the exciting half. A broken correlation is not a promise. Gold can and will have violent pullbacks. It is a real asset in a nervous world, and nervous worlds shake. There will be days and weeks that test your stomach. Sharp drops that the financial media will gleefully call the end of the gold story. I cannot tell you a price, and I cannot tell you a date, and anyone who does is selling you something. This is a case built on how the machine has changed, not a guarantee, and it is not personal financial advice for your particular situation. What I can tell you is that the structural reason gold used to fall has weakened, and that is a durable fact, not a headline. So, what does an ordinary retiree actually do with this? Not gamble. Not back up the truck with money you cannot afford to lock away. The principle is simple and old. Own the real thing, the physical metal, not a paper claim that promises you metal you will never see. Size your position so that a shakeout, a sharp drop, can never force you to sell at the worst possible moment, because forced selling into a panic is how ordinary people turn a temporary dip into a permanent loss. And whatever you do not sell into the shakeout when the media tells you the story is over. The people who get hurt in gold are almost never the ones who owned it. They are the ones who got scared out of it right before it turned. And now the part 1 have been building toward, the thing that should sit with you after you close this video. You are early. I know it does not feel that way when you see a record number, but you are. The smart money, the central banks, the institutions that answer to no quarterly earnings call, they already see it. They have been positioning for years, quietly, without a headline. The mainstream has not caught up. Your neighbor is not talking about it at the dinner table. The pension funds and the big advisory shops still recite the old rule: rates up, gold down, because their whole world is built on it. That gap between what the smart money already knows and what the crowd still believes is the opportunity, and it does not stay open forever. Because by the time this is obvious to everyone, by the time the broken correlation leads every news segment and every advisor suddenly recommends gold, The easy part will already be behind us. That is how these turns always work. The recognition comes last, and it comes to the crowd only after the people who moved early are already positioned. Nobody sends you an invitation. Nobody is going to call you and tell you the rules changed and now is the moment to understand it. The invitation is you, sitting here, watching this, while it is still early enough to matter. We are not yet in the moment when everyone knows. That is precisely why this moment counts. So let me answer the question in the title directly, the way I promised at the start. Gold did not blow past that level because of a bubble, and it did not do it in defiance of the rules by accident. It did it because the most important rule, the one that said gold must fall when safe bonds pay a real return, quietly stopped being true. The old rulebook broke. Gold now rises when the textbook says it should fall, because the buyers who matter most stopped playing by the textbook. That is the whole story, and it is the story the big banks are least eager for you to understand. If you watched this all the way to the end, you are exactly the kind of person this next part is for. Beyond the free guide, I hold a private, no-cost, one-on-one educational web conference for viewers with $100,000 or more in a retirement account, people serious enough to sit through 20 honest minutes instead of a headline. We will walk through your actual situation, what makes sense, what does not, no pressure and no obligation. And here is the honest reason to do it now rather than someday. The moment to make a calm, deliberate decision about protection is exactly when nothing feels like an emergency, when you still have the room to think clearly. That window is open right now. Once the crowd finally understands what you already understand, it closes. If you are watching on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com and mention that you watched this all the way through. The rulebook already changed. The only question left is whether you see it before everyone else does.